Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Guangshen Railway Company Limited annual report. Guangshen Railway Company Limited provides a wide range of services and businesses related to railway transportation. At its core, the company operates passenger and freight transportation services, catering to various types of cargo and passengers. The company's passenger services include operating intercity express trains, long-distance trains, and city-through trains between Guangzhou and Hong Kong. In addition, it offers other transportation services such as luggage transportation, railway operation, locomotive and passenger car leasing, and passenger services. In terms of freight transportation, the company transports a variety of cargo types including full-load cargoes, containers, bulky and heavy cargo, dangerous goods, perishable goods, and oversized cargoes. It also provides railway network usage services, allowing other companies to utilize its infrastructure. Beyond transportation services, Guangshen Railway Company Limited offers various ancillary businesses such as train repair, onboard catering, sale of materials and supplies, and cargo loading and unloading. The company also engages in real estate construction, warehousing, and catering management services. Guangshen Railway Company Limited maintains a market capitalization of $23 billion, broadly in line with the industry peer group. Guangshen Railway Company Limited trades at a lower price-to-earnings ratio of 10 times and a lower price-to-book ratio of 0.5 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 26% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.54%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. On the positive side, revenue growth has been driven by several factors, including a significant increase in freight delivery volume, operating revenue, and revenue from provision of transportation services. Additionally, government grants received have seen a substantial rise, while cash receipts from sales of goods and rendering of services have also increased. Furthermore, revenue from passenger transportation and income from entrusted transportation service have shown notable growth. On the other hand, revenue decline has been attributed to several factors, including a decrease in passenger delivery volume, number of trains operated by the company, and occupancy rates for existing intercity trains. Revenue from freight charges and other businesses have also seen a decline. The increase in principal operating costs has further contributed to the revenue decline. These factors highlight the importance of monitoring key performance indicators to understand the drivers of revenue growth or decline. The net income of the company experienced a significant increase of 210.7% from 2024 to 2025, reaching RMB 363.5 billion. However, when compared to 2023, the net income decreased by -6.1%. This fluctuation in net income is attributed to various factors, including an increase in operating revenue and a decrease in tax and surcharges. The profit margins of the company also showed improvement. The net profit margin increased from 3.91% in 2024 to 4.97% in 2025, while the operating profit margin rose from 5.43% in 2024 to 6.25% in 2025. These increases in profit margins can be attributed to the company's ability to manage its expenses effectively and optimize its revenue streams. Despite these positive changes, it is worth noting that the company also experienced significant increases in various expense categories, including selling expenses, administration expenses, finance costs, and other income. This suggests that while the company's net income and profit margins are improving, there may be underlying challenges that need to be addressed to sustain long-term growth. The company's financial performance indicates a consistent trend of generating positive operating cash flow. This is evident in the provided data, which shows that net cash flows from operating activities have been positive across various years, including 2025 and 2024. Specifically, page 9 highlights the positive operating cash flows for these years, while pages 10, 124, and 249 further reinforce this trend by showing positive net cash flows from operating activities in the fourth quarter of each year. This consistent generation of positive operating cash flow suggests that the company is managing its finances effectively and has a stable financial position. The company's debt level has undergone significant changes over the past year. A notable decrease in total liabilities is observed, with a reduction of $806,631,035 from $9,498,035,713 to $8,691,404,678. This decline is further supported by the decrease in both short-term and long-term borrowings. Specifically, short-term unsecured borrowings dropped from RMB 300,176,917 in 2024 to RMB 0 in 2025. However, a closer look at the data reveals some discrepancies. While short-term borrowings decreased significantly, long-term borrowings increased by RMB 25 million. Nevertheless, this increase is relatively minor compared to the substantial decrease in total liabilities and other types of debt. In terms of interest expenses, a significant reduction is observed. Interest expenses decreased from $104,227,316 to $74,345,861, resulting in a decrease of $29,881,455. This decline is consistent with the overall trend of decreasing financial expenses, which dropped by 19%, and interest expenses, which decreased by 29%. The performance of various segments and regions can be gleaned from a recent analysis. One notable area of success was observed in southern China, particularly within the Guangshen Railway business. This region demonstrated strong performance, although specific details regarding other areas are not available. As a result, it is unclear which regions or segments may have underperformed during this period. Management is projecting a positive outlook for the company, with a focus on constructing a world-class railway enterprise. This vision is centered around 4 key priorities: prioritizing safety, optimizing supply, improving quality and efficiency, and pursuing reform and innovation. Additionally, management emphasizes the importance of leveraging party building to empower development. The company's long-term strategy also includes holding onto Shenzhen Capital Group for an extended period, indicating a commitment to stability and growth. Furthermore, management aims to promote high-quality and sustainable development through strict governance by the party in all aspects. This suggests that the company is prioritizing responsible and sustainable practices as it continues to grow and develop. The company has a history of paying dividends to its shareholders. This is evident from various sections of the report that confirm dividend payments for different fiscal years. On page 2, it is mentioned that the company distributed RMB 0.09 per share as dividends. Similarly, on pages 13 and 36, it is stated that the company has paid dividends. The amount of cash dividends distributed in recent 3 fiscal years is also provided on page 66, which stands at billion 629,213,510. The report further confirms dividend payments for the year 2025, with a specific mention of the amount being RMB 319,857,762, page 124. Additionally, pages 128 and 129 state that dividends were paid. The dividends/buyback summary section on page 131 also confirms that dividends were paid in the amount of RMB 495,847,590. On the other hand, there is no mention or indication of share buybacks by the company. This suggests that the company has not repurchased any shares from its shareholders. The company's financial reports reveal concerns about inventory buildup or supply chain disruption. On page 20, the data shows a decrease in material and utilities consumption by 8.82%, indicating potential inefficiencies in production processes. Additionally, cargo handling charges increased significantly, while maintenance costs also rose. Further analysis on pages 206 and 207 highlights issues with raw materials provision. The value of inventories decreased by 17.3% due to a decline in the carrying amount of used rail materials and other interchangeable parts. This led to an increase in provisions for impairment, indicating potential losses from inventory write-downs. Specifically, the provision for decline in value of inventories increased from RMB 2,330,205 to RMB 4,911,625. The financial impact of these issues is evident in the company's losses from impairment of inventory, which were 4,911,625 in 2025 and 2,330,205 in 2024. These significant losses suggest that the company may be struggling with inventory buildup or supply chain disruptions, which could have long-term consequences for its financial health. That concludes the financial summary for Guangshen Railway Company Limited. Feel free to comment below, and I will be happy to answer them when possible.